Hey everyone, this is the Desert Sun with Desert Sun Crypto. I've got a good one today. Hopefully, it's as educational as I believe it to be. So, when I first wanted to wrap my head around what cryptocurrency was, in particular what Bitcoin was, no one really had a good explanation. Everyone said, well, it's digital currency, it's something you can buy on an exchange, and there's a blockchain, and there's this digital ledger. And it was all new to me. So, what I wanted to do in the best way that I think I could do for myself, had I explained it to myself about 5 years ago, is to walk through what Bitcoin is, as well as some of the cultural aspects of Bitcoin that make Bitcoin just an interesting piece of technology in the crypto space. But I want to begin by just pulling up Bitcoin and its performance uh, right around 2014 to where it is now. As I report here today, we're just under 40K at 39,996. And Bitcoin's overall height came right around April of last year. Um, I've got it at 59,384. I think actually may have gone higher. Yeah, there we go. 69,983. And that was April 12th, 2021. So just a few months ago. As you can see, since 2014, and as far as I can go back, it was at $144. But wait, we'll get into some figures on what it was. And most people, when they look at these charts and they see what things are, they're like, man, I could have bought here and man, I would have been a millionaire. Everyone thinks that. But there's some speculation that people say that 63 is going to be the cheapest it will be going into the future. Not financial advice, not a financial advisor, just showing you what the reality of this space is. Now, just to kind of dive into this, I want to start off by showing you, just kind of taking you back in time. And this was the early 90s. The first transaction that was made on the internet to buy anything was a pizza through Pizza Hut. I got a little nice screenshot of what it looked like when you used to order. Um, you got the web address webmaster at pizzahut.com. And I think it's interesting that pizza ties into the crypto space in so many interesting ways because about a decade, a little over a decade later, there's this story that is just legendary in the crypto space. There's uh, this individual right here, Laszlo Hayek, m- part of the mispronunciation, but he basically put out on a thread that he was willing to pay someone 10,000 Bitcoin if they would buy him pizza. And this took about 3 days, I believe. And then finally, he got his pizza. This is actually the pizza that he got his child going up. So at the time, that pizza was worth, with the 10,000 Bitcoin, $25. Today, holding on to that same 10,000, that individual that got the pizza for $400 million. Why is this important? Well, it goes to the nature of where Bitcoin was at the time. No one was using Bitcoin, no one was trading Bitcoin. So essentially, people were just holding on to Bitcoin. And it wasn't until people started adopting it and using it to pay for everything from a Tesla to uh, you know, paying paying athletes if you're an organization, transferring money into Bitcoin. Bitcoin just wasn't used, and so like any currency, it just comes down to the use case for it. Now, Bitcoin wasn't the first digital cash. There were some that came out in the late '90s: B Money, BitGold, Hashcash, and so on. And so again, you don't really start seeing anybody doing anything with a digital coin. You did have at the end of the '90s, though, PayPal took it to another level in being the first peer-to-peer network where you could send money to people, landlords, friends. Then the adoption of businesses came around, and Peter Thiel and Elon Musk, who created, just ended up making bank. But PayPal was the original. Then came Alipay, and I went to China a few years ago, and I didn't see one person pull out any, uh, you know, fiat currency issued by the government. Everything was paid through phones and QR codes. I thought it was interesting. And then you have uh, M-Pesa, which is used in Kenya. And it's interesting because what they had in Kenya um, was people exchanging minutes on their phones. And so the minutes became a form of currency. And so it's really interesting to think that it's not just the idea of a digital fiat, if there is such a word, but people are exchanging minutes, and you know people exchange gold, water, salt, even flowers in the past. So Bitcoin, what ultimately is it? Well, one thing that's important to note is that it's not there is no physical form of Bitcoin. Bitcoin is essentially a series of hashes like the one I have here, which is something, I don't know how many the succession is, but uh, each sequence of numbers and letters represent um, a different Bitcoin that's been mined, and I'll get to that in a second. But I remember early on thinking, well, I could probably buy Bitcoin. I can go to the bank or someplace and I can hold it. No, that does not exist. The only place you can store it is in a digital wallet. And so it is a digital currency. Some people will call it a virtual currency, some cryptocurrency, but ultimately it is kept on digital wallets. The important thing about the whole nature of Bitcoin is that it's mined digitally. Um, Now, how was this created? It was created by Satoshi Nakamoto, and this is not Satoshi Nakamoto. This is actually a gentleman named Dorian Nakamoto, who everyone thought was Satoshi. And I put this picture up because you'll see, if you were to Google Satoshi Nakamoto, you'll see this gentleman's picture. And this guy, it's kind of funny and sad because he's been tormented, forever about being the inventor, the creator of Bitcoin. He's not, but it's just like a meme that is just floating around that he is the real Satoshi Nakamoto. I guess he looks like a Satoshi Nakamoto, but it's kind of like that movie Usual Suspects, where Kevin Spacey creates his character Kaiser Soze, and there's this mystique to him. No one knows who Kaiser Soze is, and he end up finding out that it was just a fictitious person that Kevin Spacey, spoiler alert, uh, blurts out at the end of the movie. Great movie in the mid '90s, but no one knows who Satoshi Nakamoto is. Some people speculate that it's about 1 to 5 individuals who can be identified. It could be a group, but either way, no one knows about Satoshi Nakamoto. So going back to the nature of transactions, I did find a video that kind of lays out nature of the transactions. But what Bitcoin and the blockchain cryptocurrency, what it solves is this idea of a trustless system. And the trustless system takes care of something that's called the Byzantine generals problem. What it means is that if you were to have four generals, like you do here, that are going to attack a castle, let's say at noon on Saturday, the probability is that you would have only two show up at 12, and that you'd have, I don't know, some delay, maybe some horses that got rerouted or whatever the case may be. But the problem is that if you're trying to operate in a system and have everyone agreeable to, um, in this case, in the Byzantine generals problem, a time and date where something's to be executed, it's not executed effectively if you don't have buy-in by all parties. And so therein lies the Byzantine generals problem. So this video kind of lays out the solution to it, and I'll play it, and hopefully it'll describe what we'll get into with regard to the digital ledger system.
Instead, it's a clever system of decentralized trustless verification based on some of the math born in cryptography. But to start, I want you to actually set aside the thought of cryptocurrencies and all that just for a few minutes. We're going to begin the story with something more down to earth: ledgers and digital signatures. If you and your friends exchange money pretty frequently, paying your share of the dinner bill and such, it can be inconvenient to exchange cash all the time. So you might keep a communal ledger that records all of the payments that you intend to make some point in the future. Alice pays Bob $20, Bob pays Charlie $40, things like that. This ledger is going to be something public and accessible to everyone, like a website where anyone can go and just add new lines. And let's say that at the end of every month, you all get together, look at the list of transactions, and settle up. If you spent more than you received, you put that money in the pot, and if you received more than you spent, you take that money out. So the protocol for being part of this very simple system might look like this. Anyone can add lines to the ledger, and at the end of every month, you all get together and settle up. Now, one problem with a public ledger like this is that anyone can add a line. So what's to prevent Bob from going and writing Alice pays Bob $100 without Alice approving? How are we supposed to trust that all of these transactions are what the sender meant them to be? Well, this is where the first bit of cryptography comes in: digital signatures. Like handwritten signatures, the idea here is that Alice should be able to add something next to that transaction that proves that she has seen it and that she's approved of it. And it should be infeasible for anyone else to forge that signature. At first, it might seem like a digital signature shouldn't even be possible. I mean, whatever data makes up that signature can just be read and copied by a computer, so how do you prevent forgeries? Well, the way this works is that everyone generates what's called a public key private key pair, each of which looks like some string of bits. The private key is sometimes also called a secret key, so that we can abbreviate it as SK while abbreviating the public key as PK. Now, as the name suggests, this secret key, it's something you want to keep to yourself. In the real world, your handwritten signature looks the same no matter what document you're signing. But a digital signature is actually much stronger, because it changes for different messages. It looks like some string of ones and zeros, commonly something like 256 bits, and altering the message even slightly completely changes what the signature on that message should look like. Speaking a little more formally, producing a signature involves a function that depends both on the message itself and on your private key. The private key ensures that only you can produce that signature, and the fact that it depends on the message means that no one can just copy one of your signatures and then forge it on another message. Hand in hand with this is a second function used to verify that a signature is valid. And this is where the public key comes into play. All it does is output true or false to indicate if this was a signature produced by the private key associated with the public key that you're using for verification. I won't go into the details of how exactly both these functions work, but the idea is that it should be completely infeasible to find a valid signature if you don't know the secret key. Specifically, there's no strategy better than just guessing and checking random signatures, which you can check using the public key that everyone knows.
All right, I'll stop it there. I just kind of wanted to show that to just give you an idea of what these public and private keys are. Now, this how does this feed into Bitcoin and its disbursement? Well, just like the signatures are generated, there are what are called miners, and miners basically work to authenticate that um, you have a um, uh, well, I'll put it this way: the Bitcoin miners work to solve a problem. Now, the more miners there are, the more complicated it is because you have to factor in how many times each miner is cross-checking and authenticating the other. So, obviously in the early days, you have two miners, much easier to solve a problem and verify with two people. If you have something like a million miners, it's going to be much more complicated and it's going to make the mining of Bitcoin more difficult and more authentic. So rather than have, 10,000 Bitcoin that can be mined, over the course of a few months, you're not going to see, 10,000 mined, in possibly a year. I'm just throwing that out there. I'm not just saying that's the exact way or method of doing it. But the output is that um, a Bitcoin is mined, and once it's mined, it therein goes into the custody of anyone who has a wallet on the Ledger system. So hopefully that clears up that portion of Bitcoin. Now, I wanted to throw in Quincy Jones, who I think explains some of the complications that exist within Bitcoin because it's not all hunky dory, everything's perfect, and it's just a system that's just going to work for everyone. So I'll have Quincy over at Coin Club Crypto give you uh, his take on it. Go ahead and give him a subscribe if you want to get a chance. He's got some great videos.
Concerns. And the primary concern with this is in a proof of work technology, primarily what ends up happening is you have a set of nodes that are competing by trying to crack a hash by constantly trying to make a series of guesses and guesses and guesses to essentially crack a hash. And in doing so, they're all expelling a ton of energy. Now, this isn't necessarily a problem in its own right, but only one of them gets the reward. So if you have all of these nodes exposing energy, and one of them getting the reward, well, then the rest of them wasted their energy. Now, this isn't typically a problem in its own right. This could essentially be a feature of the network, and this could all be cooked into sort of like the economic rents of the network. But what ends up being a problem is the scaling portion that goes into that. And sort of a good way to illustrate that as the network, as more and more computers compete onto the network really is as the network is as powerful as, or is as efficient as the most powerful computer on the network, which means whoever has the most powerful computer operating on the network will essentially get the majority of the Bitcoin. But it essentially creates an exponential race for who can create more and more processing power to help essentially try to dominate portions of the network. And what ends up happening is you get essentially a race to the bottom of how many people can create bigger and bigger computational units. And what ends up happening is, and you sort of see this with the progression of Bitcoin, is it takes more and more and more to compete in the pool of people that are mining the coin. So a good example of this is back in 2009, 2010, back when Bitcoin was new, anybody with a laptop could have started mining Bitcoin. But as time goes on and the difficulty to mine it becomes harder and harder, not because of any of the inherent tokenomics of Bitcoin, although it has adjustments for that, but typically because of all of the other miners coming onto the network with more and more powerful processing units. Someone that could have mined Bitcoin with their laptop back in 2009 now have to have essentially a server farm with a series of supercomputers just to be in the running to essentially have that same pool of people trying to compete for the Bitcoin. And it just becomes a bigger and bigger scaling problem with the more and more resources that go into competing for mining that Bitcoin. Now,
Now, Not to confuse anyone, but he basically said exactly what the last video and it just said about Bitcoin. And two things to clear up. One is that there's the mining of Bitcoin to produce a Bitcoin. There's only 21 million in existence, and once that 21 million is up, then it is basically becomes a hard commodity unless there's some kind of release that happens to issue more Bitcoin. It wasn't designed that way, nor is it projected to be that way. However, there is something called a halving that happens after X amount of Bitcoin is produced. So, for example, every 4 years, the amount in the supply is halved, meaning, if there's, if it was 10,000 year prior, 5,000 would be distributed, and so on and so forth until you ultimately get to um, the summation of all the Bitcoin has been mined. So that's one aspect that Quincy's talking about. Now, if you have one computer, um, one laptop running the software, um, 12 years ago, yeah, your ability to get Bitcoin would be astronomical compared to what it is today. But to compete, what you have globally happening is these huge farms that are land dedicated with these open source software computers that are running all at the same time, um, sucking up, uh, you know, um, astronomical amounts of energy just to mine one Bitcoin. So the effectiveness, the cost benefit of burning all that energy for the benefit of one Bitcoin is just not becoming efficient. Now, this is something that we've seen happen in Iran. This is an article from May of this year. Iran bans cryptocurrency mining for 4 months amid power cuts. This is, this is crazy. This is the government saying, "Hey, hold on, you're like, there's people going without electricity because you're trying to mine a Bitcoin." And where else have we seen this? Well, we've seen this in China. This is a recent article from June 15th. China is kicking out more than half the world's Bitcoin miners, and a whole lot of them could be headed to Texas. Interesting. And this is what one of these huge mining farms looks like. I don't know if it's a stock picture, whatever the case may be. You'd have to have a lot of miners going at the same time. So that is much different than how some of the exchanges work. So if I wanted to go on, I had $40,000, and I wanted to buy Bitcoin, so much as someone would be willing to sell it, I could get that at $40,000. Again, like everything, just like it would be in the on Wall Street in the stock market, it could go down, it could go up, and based on what we've seen, from what it was, it's still going up and to the right, and it broke resistance here recently, and some speculate that it's going to go higher. I don't know. I really don't put a lot of faith in Bitcoin myself, just for a number of reasons. That's just my own opinion and the research that I've done. Again, not financial advice, but do your research. If there was anything that wasn't clear with regard to Bitcoin, hopefully I've cleared it up. If not, I don't mind doing a part two. Again, this is the best I could do to explain it to someone who has no idea what Bitcoin is. So there you have it, folks. A little explanation from the Desert Sun on what Bitcoin is. Don't forget to like, subscribe, share with your friends, and stick around later. And I'll have some more videos that I'm going to be releasing within the next few hours. Y'all take care. Desert Sun signing out.